On June 12th, 2026, the largest initial public offering in human history is going to happen. Not the largest tech IPO, not the largest American IPO, the largest IPO in the history of financial markets. SpaceX is targeting a valuation of $1.75 trillion. That is more than every American defense contractor combined, more than Coca-Cola, McDonald's, Disney, Nike, and Starbucks put together, more than the entire GDP of Canada. And within weeks of that listing, your retirement account is going to be one of the biggest buyers of SpaceX stock, whether you want to be or not, whether you were asked or not, whether you understand what you are actually buying or not. And what you are actually buying is not what you think it is. Let's start with the number that should stop you cold. SpaceX posted a $4.28 billion net loss in Q1 2026 alone. 1 quarter, 12 weeks, $4.28 billion gone. The accumulated deficit now sits at $41.3 billion, and the company asking you to value it at $1.75 trillion wants to raise $75 billion from the public. That $75 billion raise would far exceed the largest IPO on record, Saudi Aramco's $29 billion raise. If you ask 10 people what SpaceX does, 9 will say rockets. That is like asking what Apple does and someone saying they make phone chargers. Technically true, completely missing the point. SpaceX is not one company. It is 3 companies wearing the same t-shirt. And understanding which one is printing money, which one is surviving, and which one is a financial black hole is the only thing that matters before June 12th. Company 1, Starlink. This is the one that pays for everything else. Starlink is a satellite internet provider. There are now more than 10,000 Starlink satellites in Earth's orbit, each one beaming internet to a dish on someone's roof somewhere on Earth. In 2025, Starlink alone brought in $11.4 billion in revenue, roughly 61% of SpaceX's total revenue for the year. The margins are not just good, they are accelerating. 2 years ago, Starlink's profit margins were around 41%. This year, they sit at 63%. Starlink has maritime contracts, aviation contracts, and a classified defense version called Starshield, with contracts at the Pentagon and the National Reconnaissance Office. Starlink is genuinely exceptional. Starlink is the only reason this IPO is possible. Starlink is also approximately 20% of what you are being asked to buy at a $1.75 trillion valuation. The other 80% is where it gets uncomfortable. Company 2, the rockets. The rocket business generated roughly $4 billion in revenue last year. SpaceX launches government satellites, NASA cargo missions, crewed missions, and a growing number of commercial payloads. It is a real business, a good business, a business that would be worth something reasonable on its own. But the rocket business is not why this IPO is priced at $1.75 trillion, and the rocket business is not why SpaceX lost $4.28 billion in a single quarter. That brings us to Company 3. Company 3, xAI. In February 2026, Elon Musk merged his AI company, xAI, which also owns X, the social media platform formerly known as Twitter, into SpaceX. The combined entity was valued at $1.25 trillion. xAI itself was valued at approximately $80 billion in the transaction. xAI lost $6.4 billion from operations on just $3.2 billion in revenue in 2025. Read that again. $6.4 billion lost on $3.2 billion earned, spending $2 for every $1 that comes in. In the first quarter of 2026 alone, xAI reported an operating loss of $2.47 billion on just $818 million in revenue. xAI's Grok chatbot competes against major players such as ChatGPT and Gemini and has encountered difficulties gaining market traction, coupled with legal challenges in the US and Europe. Grok has 117 million monthly active users, but only 1.9 million pay to access xAI's advanced models. OpenAI has over 300 million weekly active users. Anthropic is signing contracts worth over $1 billion a month. Competitor Anthropic reportedly expects a 130% revenue jump, leading to its first operating profit. Meanwhile, xAI is burning faster every quarter. AI segment capital expenditures climbed from $12.7 billion in 2025 to $7.7 billion in the first quarter of 2026 alone. That is a run rate of over $30 billion in AI spending per year, against revenue of roughly $3 billion. This is the company that was just merged into SpaceX. This is the company you are being asked to price at $1.75 trillion. And this is the company that turned a standalone SpaceX that was likely profitable into a combined entity losing nearly $5 billion per quarter. Starlink is a cash machine. xAI is eating it. Now here's the part that nobody in mainstream financial media is explaining clearly. You did not sign up to buy SpaceX stock. Your index fund did. And the reason your index fund is going to buy SpaceX stock within weeks of the IPO is because someone rewrote the rules specifically to make that happen. On May 1st, 2026, Nasdaq officially updated its Nasdaq 100 inclusion rules. The new fast entry rules mean stocks can be added to the index just 15 trading days after their IPO, down from a historic seasoning period of 3 to 12 months. 3 months compressed into 3 weeks. That seasoning period existed for a reason. It gave the market time to discover the actual price before passive index funds were forced to buy in. There used to be a minimum free float requirement. A company needed at least 10% of its shares actually available for the public to buy and sell to qualify for the Nasdaq 100. SpaceX is likely to go public with a very small float. Under the old rules, SpaceX would not have qualified. Under the new rules, the minimum is gone, and then there is the hidden multiplier buried in the rule changes. For companies with a small free float, Nasdaq now weights the float as if it were significantly larger than it actually is. A 4% float gets treated as if it were 12%. A 5% float gets treated as if it were 15%. Manufactured demand, built into the index mechanics, before a single retail investor makes a single decision. Passive index funds will be forced to sell billions of dollars of Apple, Microsoft, Nvidia, and every other constituent to buy a single low-float newcomer at whatever price the market sets on rebalance day. This is not investing. This is a structural forced buy. And here is where the retail piece becomes impossible to ignore. Up to 30% of the offering is reportedly reserved for retail investors, approximately 3 times the standard allocation for an offering of this size. A structure critics say places ordinary savers in the path of a complex, opaque listing, 3 times the standard retail allocation. The CFO of SpaceX told a room full of bankers that retail buyers have been incredibly supportive and they want to recognize that loyalty. Translated out of corporate language, the largest IPO in history is going to put 30% of its supply directly in front of retail investors. Not because retail investors help with price stability. Not because retail investors improve long-term shareholder alignment. Because retail investors are loyal to Elon. And loyalty is worth something when you need $75 billion. Here is the honest summary of what is being sold. A satellite internet company printing cash. A rocket business doing reasonably well. An AI company losing billions every quarter with 1.9 million paying users competing against companies with hundreds of millions. A social media platform that lost money before it was absorbed and has not gotten better since. All of it packaged together. All of it listed under one ticker, SPCX. All of it priced at $1.75 trillion. The most recent anchor is the December 2025 tender offer at approximately $421 per share, which at the time implied a valuation of roughly $800 billion. The valuation has more than doubled in 5 months, not because the business got twice as good, because the IPO machine needed a number large enough to make the mechanics work. None of this means SpaceX is a bad company. Starlink is one of the most impressive technology businesses built in the last decade. The rocket infrastructure is genuinely world-leading, but a good company and a good investment are not the same thing. And what is being built around this IPO, the rule rewrites, the compressed timeline, the manufactured index demand, the 3 times standard retail allocation, is not a mechanism designed to help you invest well. It is a mechanism designed to ensure maximum demand at maximum valuation before price discovery has time to happen. The buyers are forced in early. The insiders are unlocked later. After reporting earnings for the first quarter as a public company, insiders can sell up to 20% of their eligible locked-up shares. Shares move from people who have held them for years at a low-cost basis to passive funds and retail investors absorbing them at peak valuation. That is not investing. That is the exit. And if you have a 401k, if you have an index fund, if you hold QQQ or any Nasdaq tracking, ETF, you are the exit. Not because you made a decision, because the rules were written to make you one. Now you know.